Today, about 50% of my net worth is invested in a portfolio of 25 REITs that I've cherry-picked to maximize total returns in a future recovery. But not all of you have enough capital to own 25 REITs, and as a result I get often asked, what REITs would you buy if you could only own 3 of them? It's a tough question to answer because there are many REITs in my portfolio that I wouldn't want to own if I was so concentrated. Here a good example would be Medical Properties Trust. I think that the REIT is quite opportunistic and I'm happy to own a small position as part of a well-diversified portfolio, but at the same time it is very speculative and so I wouldn't buy it if I could just pick 3 REITs. Instead, in this case, I will look to own REITs that have great track records, strong investment grade rated balance sheets, steady growth prospects, management teams that have more than proven themselves, no secular threats, and ideally I will buy them at low valuations to enjoy good margin of safety. Hey everyone, this is Yus. I run a small investment firm that specializes in REIT investing. In today's video I'm going to talk about 3 of the best REITs to buy for 2024. But before I get into it, could you please do me a huge favor and like this video? It will really help me a lot to grow this channel and produce this content for you. Thank you so much in advance. So the first REIT that I would include in this highly concentrated portfolio is Crown Castle, ticker symbol CCI. Crown Castle is a cell tower REIT and it's in my opinion one of the best investment opportunities in today's REIT market. That's because the company has all the characteristics of a blue chip, but it's going through a temporary slowdown in its growth rate, and as a result the market has overreacted and repriced the company as if its growth story was over forever. Historically, Crown Castle has targeted a 7 to 8% annual dividend growth rate and it's been able to even beat its own expectations. But today it's facing a temporary headwind that will likely cause it to miss its growth target in 2024 and 2025. I'm talking here about the lease cancellations that it's suffering as a result of T-Mobile's recent acquisition of Sprint. Both are tenants of Crown Castle and going forward they won't need to lease space separately on the same towers. The management has made it clear that this will impact its results through 2025. However, it has also made it very clear that they are confident that beyond 2025 they will be able to return to their historic growth rate of 7 to 8% annually. Here's what they said on a recent conference call. Beyond 2025, I will look at the business and say, based on the characteristics we see for organic revenue growth and our long-term forecast for where we think the carriers are going to invest to continue to build out 5G, which is going to take the better part of the decade, we see organic growth in AFFO per share returning to the targeted level of 7 to 8% per year. We are confident that they can pull this off because most of this future growth is already contracted today and the recent slowdown is clearly caused by a temporary anomaly. Moreover, if you doubt this management team, you should consider that they have a history of consistently under-promising and over-delivering, and they've massively outperformed the rest of the stock market since going public. Even then, the market is today convinced that the growth story is over and it has repriced Crown Castle at just 12 times FFO and a 7% dividend yield, which is the highest yield ever for the company. If, like me, you believe that the market is wrong and Crown Castle is likely to see a re-acceleration in its growth rate in the coming years, then this is a historic opportunity because it would likely lead to a repricing of the stock to a much higher valuation multiple and a lower dividend yield. Prior to this recent crash, Crown Castle was trading at 26 times FFO, which is likely a bit too much for today's higher interest rate environment, but even just returning to 18 times FFO would unlock 50% upside, and that would still be a historically low valuation multiple for the company. And beyond that, you'll also be earning 15% average annual total returns from the 7% dividend yield combined with the 7 to 8% annual growth rate. It's very hard to beat that coming from a lower risk blue chip REIT, and for this reason, if I could only own 3 REITs today, Crown Castle would be one of them. And before I go to the second company, please let me know in the comment section of this video, which do you prefer, Crown Castle or American Tower, and why? Then, if I could only own 3 REITs, I would also want to include some international diversification, and for this reason, the second company I want to highlight here is called Big Yellow, ticker symbol BYG. This is one of my favorite REITs in Europe. It's the leader in self-storage in the UK. Self-storage has historically been by far the most rewarding property sector in the US, returning nearly 20% average annual total returns over the past 30 years. These REITs were so exceptionally rewarding because they were able to earn abnormally large spreads over the cost of capital by acquiring properties from unsophisticated operators as well as developing new properties earning high initial cash yields. But I'm sure you've heard the saying that past performance is not indicative of future returns, and I think that this applies particularly well for the American self-storage market. Today, I fear that the self-storage market is overbuilt in the US, it's gotten very competitive, new properties have been built all over the place, and as a result, I would expect future returns to be quite a bit lower than in the past. However, the European market is very different. I think that the self-storage market in the UK is essentially 30 years behind the US, with less than 10 times as much storage space per capita. Even then, the concept is now rapidly growing in popularity, and the same demand drivers also exist in the UK. Big Yellow is now capitalizing on this opportunity. It was the first mover in the UK, and its early results have been phenomenal. It's been able to compound investors' capital at 16% per year, and that's despite suffering a major setback following the great financial crisis because it was over-leveraged back then. If you adjust for that, its average annual returns have actually been closer to 20% annually. It achieved these exceptional returns because it was able to grow its FFO per share by 12% per year on average since going public. And best of all, I think that Big Yellow can keep this going for a long time to come because the demand is there's relatively little competition, and Big Yellow is now busy developing new properties and earning very large spreads over its cost of capital, just like REITs did in the US 20 years in the past. Despite that, Big Yellow is today priced at a very reasonable 16 to 17 times FFO and a dividend yield of nearly 5%. Now tell me, how many REITs you know with such growth prospects that are priced at just 16 times FFO? There aren't many. In fact, just a year ago, Big Yellow was trading at a valuation multiple over 30 times FFO. But since then, its share price has crashed with the rest of the market, and as a result, it's today quite opportunistic. I think that as the market sentiment for REITs recovers from here, we'll likely see a repricing closer to 22 times FFO, which would still be a historically low valuation multiple, but this would result in about 50% upside from today's share price. So once again, I think that the risk reward is very compelling, and for this reason, Big Yellow is one of my largest investments for the coming years. And then finally, the third REIT I want to discuss here is called Camden Property Trust, ticker symbol CPT. If I could only own 3 REITs, I would also want to have one residential REIT to complete my portfolio, and Camden is probably the best pick here for such a concentrated portfolio. That's because it has all the characteristics of a blue chip. It has an A- investment grade rating, it has a long track record of significant market outperformance, it has one of the best track records of Sunbelt apartment communities, and it has very attractive future growth prospects. But despite that, its share price has recently crashed with the rest of the market, and as a result, it's today heavily discounted relative to its net asset value. We estimate that it's today priced at an implied cap rate of about 7%. But if you actually try to buy comparable assets in the private market, you'll get nowhere close to 7%. You'll be very happy and lucky to get to even 5%. Therefore, we think that Camden is today priced at a roughly 40% discount to its net asset value, which is one of its lowest valuations ever. The market is concerned here about the recent surge in interest rates, as well as potential overbuilding in Camden's Sunbelt markets. But as we noted earlier, Camden has an A- investment grade rating, and so the surge in interest rates really doesn't have a significant impact on the cash flow of the company. Moreover, Camden owns mainly Class B affordable communities that are better protected from the new supply hitting the market. That doesn't mean that Camden is perfectly immune to it. I'm sure we're gonna see a slowdown in its growth rate over the coming quarters, but this is only temporary and it shouldn't have such a major impact on the valuation of the company. Real estate and REITs should be priced on decades of future expected cash flow, and therefore just 1 or 2 years of slower growth shouldn't have such a big impact. But because REIT investors are so focused on short-term results, this has caused the share price of Camden to crash, and we are taking advantage of this. We think that cap rates are likely to expand a bit from here, which will lower the net asset value of Camden Property Trust, but even using very conservative assumptions, we still predict about 50% upside from here because the discount has just gotten so large. While you wait, you also earn a roughly 4% dividend yield, and the REIT retains about 40% of its cash flow to reinvest in growth. Finally, if Camden fails to reprice in the coming years to a more reasonable valuation, it really wouldn't surprise me at all if a major private equity player like Blackstone, KKR or Brookfield made a run for it and tried to acquire it to take it private. So these were 3 of my favorite REITs to buy for the coming years. Now, if you want to access my entire REIT portfolio as well as all my transactions in real time, feel free to join my REIT newsletter, High Yield Landlord, for a 2-week free trial. I'll put a link to it somewhere in the description of this video. And otherwise, once more, if you could click the like button, that really helped me a lot to grow this channel. Thank you so much for all your support, and see you at my next one. Bye-bye.